All Things Money with David Blain, a discussion about your money, including everything from investing and taxes to real estate. Now with this week's program from D.L. Blain and Company in New Bern, here's David Blain.
Hello and welcome to All Things Money. My name is David Blain, and on today's show we're going to be continuing our tax law update. In case you missed last week, we're starting a series of shows on the myriad of new tax laws that were enacted in the year 2010. This time of year, people start thinking about their taxes and meeting with their preparers or doing it themselves. And so we thought it might be a good idea to review some of the changes. Even if you have a preparer, many preparers out there do thousands of tax returns and they can't possibly know all about your situation, which, if I could throw in a quick commercial, is one reason we think our service is compelling. With only a limited number of families that we work with, we really do know our clients' tax situation very well. So before we get started, let's give out the phone number here is 252-633-0107. If you have any questions or comments on the show, topics you'd like covered, please give us a call. Our email is allthingsmoney@dlblain.com, and our website is www.dlblain.com. That's dlblain.com, and we'd love to hear from you. So to recap, in the show last week, we talked about the main tax law that was changed the law that was passed that continued the so-called Bush tax cuts into the future for 2011 and 2012. The main thing that these did was keep the income tax brackets the same, keeping the lowest bracket at 10% on up to 15% to a maximum rate of 35%. These tax rates were scheduled to go up to the lowest tax bracket would go to 15% and the highest to 39.6%. They also fixed the AMT as well as instituted the payroll tax cut. You should have already seen, if you're still employed, you should have seen a slight change in your withholding amount for your paycheck already. So we're going to kick off today's show. We're going to talk about a little bit about the estate tax. Now, I realize that the changes to the estate tax will make it so that a lot more of you don't have to worry about it. The rule in the year 2010, if someone passed away in the year 2010, there was no estate tax. The estate tax went away. And it was scheduled in 2011 to be resurrected with a $1 million exclusion amount. And what that means is that an individual dying in 2011 was scheduled to be able to give $1 million to any person besides their spouse, tax-free. Gifts between spouses are unlimited. So that exemption was going to capture, if somebody had a couple $100,000 in, IRAs or investment accounts, they had a nice fully paid for home, maybe a little bit of life insurance or something like that. It would be very easy to reach that exemption amount. Well, the 2010 Tax Relief Act raised that exemption amount to $5 million per person with a maximum tax rate of 35% above that. And that is scheduled to be in effect until through the year 2012. And what that effectively means is that a couple that owns $10 million or less worth of stuff will not be subject to estate tax if they do a little bit of prudent planning. The typical way to do this is when the first spouse dies, they give an amount equal to the exclusion amount, which is now $5 million, to a trust or something for their spouse. And so then when that spouse dies, the money in trust passes tax-free to whoever the remainder beneficiaries are. I don't want to get into too much on how it works. We want to stick with the tax law changes. But effectively what it allows you to do is each couple can shield $10 million. Another thing that it does, it allows what we call portability between spouses, which effectively for the next 2 years, if you don't do any estate planning and both of you die within the next 2 years, The second spouse can use the first spouse's exemption if it was not used before. Now, there's a lot of risk involved in that, and we still recommend that people give us a call and do some detailed estate planning or go to your lawyer. We have a couple of good estate planning lawyers that we work with here in New Bern, some excellent choices we can recommend to you, but there is some risk in relying on that exemption to get the full $10 million. So the other thing that the tax law did was it gives decedents the option who died in 2010 to follow these new rules or the zero estate tax rules that were in effect in the year 2010. Now, why would somebody want to do that? Well, one of the things that people gave up for no estate tax in 2010 was some of the step-up and basis rules were changed, making it less favorable for inheritors if there was a large estate. And so this tax law that was just passed allows people that died in the year 2010 an option of what they would like to choose. Another very good provision of the 2010 Tax Relief Act continues the gift tax rate of 35%, but it raises the applicable exclusion to $5 million. And so it's the same as the estate tax exclusion now, meaning that you can wait till you pass away, give away $5 million to children or a trust or something tax-free, or you can do it during your lifetime. One thing I ought to mention too is gifts to charity, of course, reduce your taxable estate. So the simplest estate tax plan, if someone has millions of dollars and they don't want to pay estate tax, the simplest estate plan is just give it to a charity and there will be no estate tax. Typically, we see people trying to pass money to their children, and that's where the estate planning comes into effect. But if you plan to give it all to a charity, there will be no estate tax. The generation skipping transfer tax, which is a tax that is imposed when you skip a generation. So, for example, if you were to give money to your children and then they died, it would be an estate tax before it passed to the grandchildren. So what people did was they say, well, I'll just skip my kids and I'll give it right to my grandchildren. So Congress, they didn't want to lose out on that double taxation of taxing each layer of generations, so they enacted the generation skipping transfer tax, which effectively imposed an additional tax if you skip a generation when passing money down. And so that works in tandem with the estate tax, and the exemption tax is the exemption amount is $5 million for that as well. So we're going to take a short break here. When we come back from the break, we'll continue our discussion about the 2010 Tax Relief Act and the changes as they apply to you.